My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends. I'm just trying to make you some money. My job's not just to entertain, but to teach you, educate you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Here's the deal. If you believe everything you read about the economy right now, you think we're having a recessionary boom or an expansive retraction. Somehow it's both great and horrible. Yep, that's why this market seems so schizophrenic. We have so many negatives within a wildly positive framework that we can't process what's going on. Hence how the market could open so horrendously, then rally off its lows, only to pull back again. But the Dow finishing off 35 points, it was much lower at one point, S&P slipping 0.61%, and the Nasdaq losing 1%, also much lower at one point. The sellers seem convinced that the economy is about to get weaker because after last week's red-hot unemployment number, 500,000 new jobs, unemployment rate down to 3.4%, the Federal Reserve's got to lower the boom on us, correct? Fed Chief Jay Powell speaks tomorrow. If you think he's about to bring the pain,
the house of pain,
it makes sense to sell ahead of
sell.
But on the other hand, the buyers, buy. Well, they scoff at that entire logic. They said the Fed chief couldn't cause a recession if he tried. In some sense, it does seem like he's tried. Given that the hiring is so robust, they simply are not worried about the Fed. They figure the only outcome is a soft landing for the economy, which means it's foolish to sell now, since you'll only end up buying back those same stocks at higher levels in order to get in ahead of the turn in 2024. Now, I fall in the latter camp, in part because the job market's so resilient, but mainly because I have faith in Jay Powell's ability to land the airplane safely despite any near-term turbulence. To be truly rigorous, though, you know what you have to do? You always have to challenge your assumptions, challenge your thesis. And that's something I teach members of the Investing Club every day, including just last Saturday. Always chastising myself when I get it wrong. You can never just say, hey, I don't know, I'm brilliant.
They know nothing!
So let's lay out the bull case and then the bear and the rebuttal so you really get how difficult it is right now. For instance, first the Fed chief himself. My belief is that when Powell tightened too aggressively in late of 2018, taking a very tough game of lockstep rate hikes, we hate those automatic rate hikes, he learned how important his words are. I'm betting he will not be dogmatic again. The bear rejoinder is simple. Powell screwed it up in 2018, then kept rates too low after the pandemic, totally leaving out that he was late because he was worried about the Omicron variant. Never mind that he's been much faster to tighten than many other central bankers around the world. To the bears, Powell's from the gang that couldn't shoot straight. That's his school of central banking. In their eyes, he's never gotten it right, and he's going to tighten us right into a huge recession. The bulls respond that wages barely budged last month, so why does it matter? If we can create 500,000 jobs without much wage inflation, that's a best-of-all-worlds situation. But the bears think that that's absurd. Since we were only looking for less than 200,000 new hires, anything beyond that could eventually cause businesses to raise wages simply because we have an obvious labor shortage in the country. Other than the bulls say, wait a second. Yeah, they're layoffs. We just saw 6,650 people laid off at Dell. I mean, that's 5% of its workforce. We know there's been layoffs at Amazon, once at Alphabet, Meta. And those are just the big ones. How many privately held tech firms had to go under because they couldn't raise any money? But to the bears, that's not meaningful at all, because those layoffs are all happening in tech, and they aren't big enough to move the needle for the whole economy. They say you can't just go by these noisy Silicon Valley layoffs. They're not meaningful. So the bulls respond. Powell's already committed to a couple of quarter-point rate hikes. He probably had some insight into the labor report that came out 2 days later, don't you think? That number was an anomaly anyway, given all the weak data we've gotten lately, all of those weak PMI reports. Things are still deteriorating in the economy. Look how oil keeps dropping. Look at the ridiculously low prices of natural gas. This is not what an expansion looks like. So just ignore the employment number. The bears aren't buying it. They say it's always been right to trust the employment number. Always. And you know what? I agree with them on this. You can never asterisk the labor report. And if we keep getting figures like this, we are going to need a lot more rate hikes. That's why long-term interest rates are so much lower than short-term. The bears figure they're signaling the recession to come. The bulls come right back. It's exhausting, pointing out that the world's economy is making a comeback thanks to the reopening of China, which can be the engine of global growth. The Eurozone is getting stronger, and it's obvious the United States remains in good shape. Why not buy? But the bears have the ultimate checkmate. They say if the bulls are right about the rest of the world getting stronger, then commodity inflation, the one kind of inflation that the Fed's already crushed completely, is about to make a comeback. If that happens, things will go completely awry. Higher oil, higher natural gas, higher copper, higher aluminum, and even higher beef and chicken. A nightmare if you're worried about inflation, and that's the Fed's #1 concern. In the end, I'm not a macro hound. This is not my world, okay? I'm a micro stock picker, focused on individual companies. But the way we view earnings from a company is entirely through this macro prism, even if you don't agree with it. Wall Street looks at the world this way, and Wall Street's in charge. Take retail, just to give an example of something we all know. Right now, despite the boom in hiring, where typically it would mean that retailers are terrific, the stocks that are acting the best are the dollar stores and the discount outlets. Here I'm thinking about Dollar General, Burlington Stores, TJX, which we own for the charitable trust, precisely for this reason. The worst retail stocks are the full-price department stores like Nordstrom, which is doing just okay, but got jacked up to $27 by Ryan Cohen, the alleged savior of GameStop, who's trying to shake things up after taking a major position. Well, you know I said sell right into this, and today we got the true colors. The stock plunges more than 8% back to 24. That's because the full-price retail simply isn't working, despite the 500,000 jobs created last month, which would typically be great for full price. I know, it's totally counterintuitive. I've never seen anything like this economy in my life. Because as I say, and get rich carefully, the non-farm payroll report is the most reliable statistic. It comes out right now. And right now, that number unequivocally supports the notion of a soft landing. You simply can't get a hard landing when you're seeing this much job creation. As for those who think that the January number overstates our growth, that it's somehow an outlier, listen. I've heard it many times. I've heard that complaint. Yet it's never been true, ever. I'm also not willing to say that a good number is a bad number because somehow it will force Jay Powell to raise interest rates like crazy and throw us in recession. I think that's unhinged. Powell said he wants disinflation, and that's what we're getting pretty much everywhere outside of wages. And he's making progress with wage inflation, too. If he can beat inflation without carpet bombing the entire economy, I think that's a good thing, and you're going to be a buyer at every single dip, and I think that's what's going to happen. I think he's pulling it off. I'd even go so far as to say that the bond market's wrong. Long-term bond yields are much lower than they should be. Long-term bond yields are lower than short ones, signaling a recession, and I think that's simply incorrect. Oh, and don't sniff. The yield curve, as is known, doesn't have a sterling record of predicting anything. So here's the bottom line. Ultimately, you need to have a worldview. My view is pro-Powell. The economy softens without a recession, which is bullish. The soft landing case strengthened, not got weaker on Friday's numbers. Period. Bye. End of story. Trey in Texas. Trey.
So, Jim, I recently finished Gregory Zuckerman's The Greatest Trade Ever. And I don't want to get ahead of myself, but I wanted to see if you think it's at all likely that there will be a revision to the story, detailing my unprecedented foresight in allocating my entire portfolio into Target before it became the largest company on Earth.
Huh? Target's not that large. It's smaller than Walmart. I think you got to rethink your game plan. I think even Wikipedia could get you in a little more. Well, I don't want to be too critical, but I wouldn't worry about that one. I think you got that one kind of off base. Let's go to Mark in Massachusetts. Mark.
Hey, booyah, Jim. How you doing?
I am doing well. How about you, Mark?
I'm doing great, So I'm having a little trouble here, Jim. I've been holding the stock for quite some time now, and I know you have too, and I'm just wondering if it's the right play in the EV market or if I should move on to something else. It's been at the same price now, for over a year. For actually 5 years ago, if we look back, it's at the same. And I'm talking about Ford Automotive.
Yeah, you know, Mark, I'm worried too. And Jim Farley did leave $2 billion on the table. It was really ugly. I've made it very clear that my charitable trust will give Ford the boot if they don't do this quarter, because Farley says they must do this quarter. I agree with him, and if they don't, then it has to go. I made that point, by the way, in this really terrific investing club meeting this Saturday. You can go look at a replay. But I really am putting the feet to the fire. You know, it's time. It's time that Ford got it better. You know it, and I know it. And otherwise, it's time to go. All right, my view is pro-Powell. The economy softens without a recession, which is bullish. The soft landing case strengthened, not got weaker on Friday numbers. Columbia Sportswear, by the way, beat on the top and bottom lines last week, but inventory levels remain high. Is that worrisome? Is the stock going to be left out in the cold, or will it be headed up? I got the CEO. Then, is the rally in the S&P going to run out of steam anytime soon? Well, we'll go off the charts to find out. And can the bull market in the ag sector, which you know I like so much, continue in 2023? We're going to go to the largest seed and crop protection company. That's Corteva. We'll speak with the CEO. Mad Money's back after the break.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.